This podcast is kindly supported by Resolute Investment Managers, Inc. and 91 Asset Management. Resolute Investment Managers, Inc. is a diversified multi-affiliate asset management platform that partners with more than 30 best-in-class affiliated and independent investment managers. It offers a unique platform that delivers strategic value through the full suite of distribution, operational, and administrative services available to affiliates and partners. 91 Asset Management is a global asset manager with emerging markets roots that brings a different perspective to active and sustainable investing. Our next guest expects better when it comes to getting more women into portfolio manager roles. Hear about her firm Expect Equity and the work she is doing to create an incubation cocoon so that female portfolio managers can thrive. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Hallie Label, who's the founder of Expect Equity based in Baltimore. She was previously Chief Operating Officer at Rock Springs Capital, and prior to that was a principal at Makena Capital and an associate at Hallie Capital. Welcome, Hallie. Thanks for joining me today.
Thank you so much, Aoife, and it's a true pleasure to be here.
Well, let's start where we always start. We'll definitely come to speak a lot about Expect Equity and what that is and what you're focused on. But let's go back to your background and the beginning of your career. Where did you grow up? What were some of your early interests? And how did you come to enter investing in finance?
I grew up in Memphis, Tennessee, the oldest of 4 children. I have 2 younger sisters and a younger brother. And I was privileged to attend an all-girls school, which I think was really important in my career journey ultimately, because at a very young age, I was taught that girls and women can do anything. And I think that was a very critical lesson. I love sports. I played soccer and basketball as a kid, and I played rugby in college. I think the team element and competitive nature of sports, as many people are well aware, is highly beneficial in careers. And my earliest sort of interest in investing, and I can't remember what sparked it, but I got $40 for my bat mitzvah, and I used that money to buy a share of stock. So I have a very vivid recollection of sitting in my dad's office, calling his stockbroker and discussing the merits of Anheuser-Busch, which I know is perhaps an odd choice for a 12-year-old, but that's what I spent that money on. So I've been interested in investing for a long time. That was kind of the start of my journey.
And let's go from there then into college. Did you study economics or a financial related course? And first early career?
I majored in economics at Princeton. I graduated in the late 90s, and actually a professor there that I was good friends with, her husband worked at Putnam Investments, and it was through her that I was able to get an interview there and ultimately begin my career there. So I started early on as a junior equity associate on the buy side, working for an analyst who covered brokers, asset managers, and consumer goods companies back when that meant, cereal. That's where I got my start.
And then the 2 firms that I listed in your bio, Hallie Capital and Makena, they would be kind of, I suppose, more like, I don't know if you call them outsourced CIO or endowment model. Can you talk us through what kind of firms they were?
Sure. So I made my way over the course of my early career in my 20s. I came to realize that it was really the business of asset management and choosing people that I was more passionate about than choosing stocks directly. And so after business school, I worked at a hedge fund for a period of time, and I really learned there that it's not just the series of returns that matter, but relationships with institutional LPs, the way you build a back office. And after that experience of working at a fund that did not scale, I pivoted to becoming an allocator. And was fortunate to get an opportunity to join the equity manager selection team at Hallie Capital in 2006. And so my allocator experience spanned 8 years from 2006 to 2014 at both Hallie and Makena. And I learned an immense amount from that experience, got a very broad breadth. I was responsible for manager diligence, investment diligence, and operational diligence across all strategies where a public equity was the predominant security. So long only, long short, public-private hybrids, and across geographies, emerging markets. In particular at Makena, we had a substantial allocation to emerging markets back at that time. So it was really, these were 2 fantastic firms and opportunities for which I'm really grateful to have learned to be an allocator and learn to select managers.
And let's move then to Expect Equity. So Can you talk us through the vision for that and what it does?
So Expect Equity is really the culmination of the 25 years that I've spent in the industry sitting on every side of the table. So after Makena, I was the COO of Rock Spring. So I have been a direct public equity investor, an allocator, and an operator. So in the course of building this firm, the vast majority of people with whom I speak, I understand their job and their role pretty well because I held a similar one at a point in the past. And through this quarter century, sort of as a participant in and observer of the industry, I have come to understand that the systems of capital formation serve some people better than they serve others. And I believe and expect equity exists because investment excellence is broadly distributed and capital is not. And that is really the key and core problem that Expect Equity's fund structure seeks to address. So we are an incubator for underrepresented public equity managers. We define underrepresented very broadly. Our managers are employees of Expect Equity during their time in the incubator. They get 3 years to invest, build a track record, develop relationships with high quality institutional LPs. And they do all this while we maintain a back office that is commensurate with what institutional allocators would expect at much larger firms.
And I'd like to just back up on that a little bit, because that definitely is a truism in our industry that talent is universal, opportunity is not. And having played sports, I'm sure you're well aware about the disparities between male and female sports, and perhaps things don't always work out fairly in that arena either. When did you start in your investing career? When did that kind of factor around perhaps the opportunity not being equal? When did that start to set in for you?
I mean, to be frank, it's not clear to me that I ever lost an opportunity because of gender or that I was directly impacted by it. It was more as a participant in this relatively tight world and looking out at those to whom capital was allocated. I think that's where the largest disparity exists. And I think there are a lot of reasons for that. I think that fundamentally, when people go out to raise capital, the two things that matter most in that equation are earning somebody's trust and earning their belief in your future potential. And I think that it is just human nature that people tend to be more drawn to those who are similar to themselves. And because the vast majority of capital in this country and frankly globally is controlled by men, then the vast majority of the decision makers are men. So I think it's actually not surprising, purely from a human nature perspective, I'm not trying to blame anybody, that this is a problem. But the fact that it's a problem means that there need to be intentional solutions to identify talent and spur allocation to it.
And let's talk in particular about the PMs that you provide this incubation around. What does incubation look like to you? Where do you feel the gaps perhaps are the greatest that you can fill in? And how do you do that?
So again, this is all based on my personal opinions and observations of the industry. But what I have observed is that many individuals, when they go out to launch a firm, particularly if they are not going to be terribly well capitalized when they do that, either operationally or in terms of fund capital, I often hear, well, if I perform, they will come, right? There's this assumption that performance will drive capital raising. I don't actually believe that that happens very often at all. I think a lot of these decisions are based on the existence of long-term relationships, a comfort with the back office infrastructure and the control environment that somebody has built, combined with a record of investment excellence or a reason to believe that somebody is going to be able to generate investment excellence because they've done something very similar, or come with a reference from a very well-regarded senior investor with a long career and record of success. But the people who have access to those references, that capital, whether because they were a participant in a carry pool, or whether because they have the family wealth, whatever it is not, in my view, the entirety of the subset of talented investors who deserve a chance to get capital from institutional investors. So I think that's where kind of the wedge is. Allocators are typically not in the business of creating new managers. They are in the business of assessing and selecting amongst an existing pool. But that existing pool is constrained by a wide variety of factors that lead to a skew. And that is what the design of Expect Equity is meant to address, is to broaden that skew while recognizing and acknowledging the very real challenges and on the ground realities that allocators face, which I can do because I was one for many years.
We're going to take a short break from the program to chat with one of the sponsors of this podcast, Resolute Investment Managers. I sat down with Jay Schilling, Vice President. Jay, looking to the future now, how do you see the landscape evolving and where do you think the opportunities will lie?
Yeah, we will be doing more of, I would say, four things. One of those is actually different than what I had mentioned already previously, but active ETFs is one. There will be more of that liquid alternatives specifically within an active ETF structure, also potentially credit down the road. So active ETFs is one. More model delivery SMAs, so more separately managed accounts that can be done in model delivery. Wirehouses historically have had very good technology for model delivery SMAs. Wire RIAs and independent wealth management firms now plugging into technology in the back end will be able to have a lot more access to model delivery SMAs. So that's going to continue for us. CITs, again, in retirement, in even more unique potential asset classes outside of just large cap value or small cap value. It could be multi-sector bond. It could be high yield bond. It could be, certainly more and more asset classes that would be able to fit in a CIT for a smaller plan. And then the last one is actually private vehicles. So we actually do think that private structures, there are a tremendous amount of unique products that have still not been done in private structures for retail clients. So whether that's through a master feeder structure or more innovative structures on the private side, there are a lot of unique products. And we work, of course, with big alternative shops, Man Group being one of them, which is one of the largest publicly traded hedge funds in the world based out of London. And we have a suite of strategies there on the mutual fund and ETF side. But there are a tremendous amount of private vehicles that could continue to get pushed into the retail space for a much easier access and then exposure that has, again, historically been dedicated and geared towards the mega institutional channel.
And now back to the show.
And besides the incubation aspect, so you're now an entrepreneur yourself, what's on the forefront of your mind as you look at the evolution of the landscape, not only for Expect Equity itself, but for the firms that you're incubating? How do you see client needs as evolving? What products are going to be needed in the next 5 years?
A lot of questions wrapped up in there. So I'll start with client needs and products. So Expect Equity is designed for active public equity managers, whether long only or long short, who run concentrated portfolios where decisions are predominantly based on fundamental research. So that's a pretty narrow slice of the broad asset management universe, but that's all we do. We're very focused on delivering on this one slice. And I should have stated this earlier, but we have one goal as a firm, and that goal is to launch independent firms with at-scale funds run and owned by underrepresented managers. That's what we're trying to accomplish. I do think that particularly given the sort of performance characteristics of a certain subset of large cap growth stocks, that has exacerbated the predominant wins against active equity. A lot of people talk about sort of the death of active equity. A lot of capital is moving to passives. I think that broad trend will continue, but the more it continues, the more opportunity there is for active equity managers to outperform. So I actually always think there will be a market for and a role for very focused firms that are small with constrained asset bases, trying to do one thing and do it very well. In terms of sort of looking out at the asset management landscape as an entrepreneur, I think what gets any entrepreneur excited is to see an opportunity that others either fail to see or don't appreciate or undervalue. And so for me, I'll tell a quick story. I was speaking with an allocator, this was quite a while ago, who said to me, and I quote, "What you are doing is cool and interesting, but our board just can't lower its standards." So sight unseen, having never met any of the managers that we proposed for the program, either he or his board, or more likely both, had this clear bias that he expressed to me on a call against a certain subset of people, right? And what I'm learning to do over time is rather than be frustrated by that, and it is frustrating, that epitomizes the reason that this opportunity exists, right? if that bias were not widely held, the opportunity to create these new businesses wouldn't exist. And so I have learned that the existence of apathy and antipathy can be harnessed to try to create something new and to try to enable that the value of what is newly created to accrue to those who truly believe in it.
I'd love to go back to the OCIO experience because we talked a little bit about evolution. That industry fascinates me as well because that has evolved. And I suppose from that vantage point, anything that you think is really, we're going to see change in that industry too?
I think the OCIO industry is going to continue to grow. And the reason is committees are made up of volunteer board members who almost always lack the time and sometimes lack the expertise to exercise effective fiduciary oversight over pools of capital. So if you're too small, and again, obviously, billion-dollar pools or more have the resources to bring a team in-house. But for those that are smaller, I think outsourced solutions have made and will continue to make a lot of sense. So obviously the model has proliferated. There has been sort of a mixing where firms that were more traditionally investment consultants have tried to create and grow OCIO service businesses. I think that growth will continue, and I think the evolution of the business model will also continue. So in terms of how I think about manager sourcing and evaluation, for any fundamental equity strategy, I think the best opportunities for outsized returns, capital appreciation, and outperformance come from inefficient markets. So we are less interested in large cap US strategies, again, particularly with the sort of Magnificent Seven and its impact on the performance of the S&P, for example, and more interested in managers who are either in a sector vertical, smaller cap vertical, or potentially international. So I wouldn't say that's necessarily a hard and fast rule, but I do think that most allocators, at least those with whom I have relationships, get excited when they see a mix of talent and inefficiency. I think that's sort of the best opportunity to generate outsized returns. And so we do focus on areas of the market that we believe are less efficient and will continue to do so. But there is I think this is important. I'm not doing any top level portfolio management saying, I like healthcare, or I like technology, or I like emerging markets, or whatever it may be. We are very much looking for best athletes who have a record of academic achievement, resilience, and success throughout their life, and have achieved that rung on the ladder right below portfolio manager. Or they may have been a portfolio manager, but it's not required. And it's also not required that they have a relevant track record. And if I could segue on that piece for just a minute, a lot of times, particularly when somebody works at a large long-only firm, if they are so fortunate as to be promoted into a portfolio management seat, it may be the case that they're running a fund with assets, that are perhaps too large for what the addressable market is. And so they intensive requirement, they have a portfolio of 80, 100, 120 stocks. That's not going to be of interest to us, but that also doesn't mean that that investor is not capable of excelling running a more concentrated portfolio. So they have to want to do it, but they do not have to have done it previously. And what we often see as well is that at many firms, the people sitting in those portfolio management seats are young enough that they have many career years left. And so there aren't many seats that are available. And as widening and expanding the universe of talent to which those firms made offers kind of 5, 10, 12 years ago, there are a lot of people who have the relevant experience, but that PM seat doesn't exist, or too few of them exist. So that's also an opportunity for us in terms of talent sourcing.
The classic case of top-heavy firms and no room at the top because of that. Very interesting. And I suppose one question, given remote working, COVID, etc., it is said that the PM role is an apprenticeship role. Essentially, it's very much learned by the side of an existing PM, for example. Mm-hmm. Do you find that training is as forthcoming nowadays? I know some firms have made a specific effort to train female portfolio managers because they've seen that they haven't naturally fallen into the apprenticeships for whatever reason. So they actually now are intentional about ensuring that women are on that track. And there's also the whole idea of portability of performance or preservation of performance, particularly around times, say, during a maternity leave or something similar, when there will be a natural gap. I've seen some programs in place here in the UK around specifically how do you handle performance that might have a break like that, and actually coming up with a standardized way to do it. So any initiatives that excite you in terms of a more modern way to perhaps groom these managers?
I would hazard a guess that the UK may be ahead of the US in this regard. Certainly that training is incredibly valuable, but it's not always available. So we don't limit or constrain the pool of people that we will consider based on our assessment of the individual or firm who trained them, because people have to be able to kind of observe and develop their own investment process and their own investment style. And they may do that over time through a combination of their own personal investing, their network of peer investors, as you referenced, the guidance of a boss or several bosses. So I think there's a broad kind of landscape that mosaic of somebody's investment process and style gets built over. And we don't have any hard and fast rules about the role of a particular individual in forming or grooming somebody to take on that PM role. I'd say the other thing I would mention is, the title portfolio manager has little meaning, in my opinion, without asking a series of further questions. So, for example, some firms, to preserve their Morningstar ratings, may want to demonstrate lower turnover. So one way to demonstrate lower turnover is to add portfolio managers to a team so that if anyone leaves, your turnover percentage stays lower. So whenever somebody indicates to us, in our very early diligence when we're first meeting that they're a portfolio manager, I spend time talking to that person about what exactly does that mean at your firm? Are you a sole decision maker on a large pool of capital? Are you a sole decision maker on a small pool of capital? Do you have a co-equal manager? Are you a subordinate portfolio manager where somebody else, you're perhaps influencing, but somebody else is the ultimate decision maker? So I think it's very critical for somebody in my seat to kind of understand the nature of the firm that somebody's coming from and what that title means, because it means a lot of different things, different places.
And I'm sure many's a person has been hired into the wrong slot because of the individual not asking those questions.
Yeah. And I mean, one other comment I would make about your question on the training under a senior portfolio manager. Senior portfolio managers can vary widely in talent, style, culture, investment culture that they sort of create on their teams. So sometimes it's a good thing and sometimes it may not be a good thing. So that's why we really focus on the process as that person, wants to implement it going forward.
Let's go back to some personal reflections now. So you've had a long career across some different kind of outfits and now on an entrepreneurial role in your own. What were some of the highs and lows of that career so far?
So interestingly, and when you posed this question earlier and I reflected on it, I would say there really haven't been very many lows. There have certainly been circuitous twists and turns, but I'm a believer that serendipity is your friend. And if something doesn't work out, you make the best of it. And I've always managed to kind of learn from situations that may not have worked out as I had anticipated they would, and take that learning to build something bigger or into another environment. So, Expect Equity has by far been the high point, even though we're still very, very early in our journey. It's absolutely a privilege to do the work I do and one for which I'm grateful every day. But I wouldn't say there have actually been that many low points.
It's great that you do frame them as you do. I think that's always a learning experience. Would you say there were any lessons learned through some of these twists and turns and unexpected, perhaps, shifts in the road?
People matter a lot. And as an allocator or as a manager selector, you can spend an immense amount of time trying to understand somebody's investment process. Some people would call it an edge. That's not my favorite term, but there are sources of differentiation. But at the end of the day, regardless of how well developed and refined that process seems to be, it's a person who may or may not be focused, may or may not be motivated, may or may not be humble, may or may not be able to learn from their mistakes that's carrying out that process. And so I think the biggest learning over the course of my career has been not that the process doesn't matter, but that results ultimately come from people. People are human, they make mistakes, and they need to be able to react to those mistakes. And so how they treat others, the level of humility they have, and whether they have a learning mindset and a growth mindset, I think is critically important.
Very well said. And speaking of people, given how much they matter and continue to matter in terms of how we plot our course through life, were there any particular people that were mentors to you or that had a particularly formative impression on how you see the world, how you work?
So my grandmother lived to be 103. She died about 12 years ago. And she is what we would today, call a badass. She was ahead of her time. She was a mover and shaker who was probably born 70 years too early to have the impact that she might have had. But I very much feel that her legacy lives on in my life. My parents are the source of my values, and they sacrificed so that I could go to the all-girls school that I referenced earlier. And I can't understate the extent to which empowering girls matters immensely for their future. And I owe that to my parents. And then I think it's ironic, and I imagine that you will recognize this and have heard this, because I think men are never told this or provided this guidance. But for women, it's common to be told the most important career decision you will make is who you marry if you choose to get married. My husband's a venture capitalist. He's incredibly supportive. As an entrepreneur, it is absolutely my good fortune and privilege to be married to a venture capitalist who has a sense of entrepreneurship broadly, whereas I have only a sense of it narrowly. And his, I think, most critical piece of advice to me is it's always a journey, right? There's no test with an A waiting at the end of the road, right? There's no promotion. Like, those days are over. There will always be things that you haven't accomplished, but you do have to look back every now and then and observe and be aware of and appreciate how far you've come. And then you get back on the bike every day because you're excited about the journey and because you enjoy the journey. And so think about it more as a journey and less as a destination.
I love that. We've already got our words of wisdom there, but I have to go back to your grandmother, because you would be surprised at how many times grandmothers come up in that question. And when you said she was a badass, can you give us some examples? Because I'm not getting a picture just yet.
I mean, she was literally probably 5'1". And for the majority of her adult life, she did not have a traditional job, but she was very much self-taught. She didn't go to college, but she was an avid reader. And she never minced words. She told you straight where you stood and how she felt. And she was born in 1908. I think most people in that generation did not have that sort of sense of quiet power and really self-confidence that I think she had. And it rubbed off on me, and I think it rubbed off on my siblings.
What a legend. Well, we sadly didn't get to interview her, but thank you for bringing her to life here a little bit for us.
Of course.
Besides your husband's reminder that it is a journey and that we are figuring it out along the way, any final word of wisdom you can leave us with, or any advice maybe you would have given your younger self?
So when I talk to people who are behind me in career tenure, back to the earlier point, I tried to make that people really matter. My earlier self spent a lot of time trying to write exceptional memos and make very thorough and detailed models. I think I was too focused on sort of merit in a narrow sense in terms of work output that could be measured or assessed by somebody, and not focused enough on developing relationships. And so what I tell younger people now, and what I would tell my younger self, is close Microsoft Word, close Excel, go have coffee sometimes with people earlier than you and listen to what they say, and have coffee sometimes with people younger than you and pay it forward.
Well, thank you so much, Hallie. My conclusion from this conversation is that is now your raison d'etre is to pay it forward. By having an incubating style vehicle, you are taking all of this wisdom that you've assembled throughout your career, using it to wrap around these emerging fund managers. So what a gift it is to them, and what a gift it is to the industry to allow us to see them and witness them grow. So thank you so much for coming here and sharing your insights with us.
Thank you so much for having me. It's been a pleasure.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.